In this training session, we will discuss the projections and modeling feature in the General Ledger module. Using this feature, you can project your company's financial performance 3 years into the future. The projections take the form of printed pro forma balance sheets, income statements, and cash flow projections. The figures on these printouts are based on your entry of projected sales, costs, and general expenses, as well as what we will call management discretionary items, such as putting money into or taking money out of the company, taking out loans, buying fixed assets, and the like. To use this feature, select Projections Modeling from the General Ledger main menu. Here's a screen with a list box that will hold multiple projection models. We already see one projection that has been entered previously by David. We'll add a new one of our own by clicking on the Insert button. We'll give our projection a description and then get started supplying the information required to print our projections. First, we enter the month we want our projections to start. We'll say March of 2016. Now, if we have a March 2016 fiscal period set up, we should select it here. This is so that the system can use our actual February balances as a starting point for cash and balance sheet projections. We also need to select the ending month of our fiscal year. For most companies, this is December. Finally, we need to pick our cash line item from this representation of our financial statement setup. Now we click on the Sales and Cost of Goods Sold tab. This is where we project what we will sell over the 36 months starting in March. When we click on the Insert button, this screen shows a list of all 36 future months. Our job is to enter an item or a service we plan to sell, and project how many of them we will sell each month. Start by indicating an item. If you've set up the item price file, you can click this lookup button and pick from a list of inventory items. Otherwise, just make up an item ID and description of the product. Next, indicate how much you will sell each unit for and how much it costs you to produce or buy one unit of this product. You will also be required to select which line item on your financial statement is used to report sales of this item, and which line item is used to report cost of goods sold for the item. These two line items will be filled in automatically by the system if setup is done properly. Now we need to project how many units of this product we will sell each month. An easy way of doing this is to start by indicating a static quantity. In other words, the same number of units every month. We can then go back later and increase or decrease the projected quantity for any given month. Click on the Change All Quantities button and indicate how many you plan to sell per month. When you click the Proceed button, you will see the columns for all 36 months filled in accordingly. Now we can go back to a particular month and increase or decrease the projected number of units we will sell during that month. Now we can click the OK button and we will see the item we just entered with the total projected sales and cost for all 36 months. We can repeat this process as many times as necessary until we've covered all the products or services we plan to sell. Let's just add one more. Next, we click on the General Expenses tab. Here, we need to project how much money we plan to spend on general monthly expenses like rent, utilities, telephone, marketing, office supplies, and the like. This can be a long list, but it's important that we are meticulous so that our projections are accurate. To add a new projected expense, click the Insert button. This screen shows a list of all 36 months. Click on the Lookup button and pick one of your general expense accounts from your chart of accounts. Now indicate how much this expense will be each month. As before, we can click on this Change All Projections button to put in the average monthly amount we will pay for this expense. We can go back later and increase or decrease specific months. Now we'll add a couple more general expenses. Once you've entered all your projected general expenses, click on the Cash Credit tab. The information we enter here will help the computer create a cash flow projection. First, notice that once again there is a list of all 36 projected months. The total sales column represents the total of all the product sales we projected on the Sales and Cost of Goods Sold tab. For each listed month, we need to indicate what percentage of those total sales will be cash sales. Cash sales are sales in which you receive the cash during the same month in which you make the sale. Credit sales are sales for which the cash will not be received until a subsequent month. To make it easy, we can use these fields on the right to apply our cash sales percentage to all months. Then, as we've seen before, we can increase or decrease the cash sales percentage for individual months. Let's say that traditionally 60% of all our sales are cash sales. We enter the figure here and click the Apply to All button. Notice how the figures change in all the months in the list. Now we need to tell the program when the cash for our credit sales will come in. Usually, if we sell things on credit, that means we send the customer an invoice, which is due the next month. If we traditionally collect all our cash in the following month, we can say that 100% of our credit collections will happen within 30 days. If this is unrealistic, we can specify how much of our credit sales we can truly expect to collect within 30 days, 60 days, and 90 days of the sale. Enter the figures here and click the Apply to All button. You will see the numbers fill in the list box accordingly. Once again, if we want to change the settings for any particular month, we can do so by highlighting the desired month and clicking Change. Here you can see that we can modify both the cash percentage and the cash collection percentages for this month. Finally, we need to project what decisions we will be making at a management level that will affect our financial status. Click on the Management Discretion tab. When we're finished, this list box will contain a list of all our projected management decisions. Let's click on Insert and explain further. The first thing we must do is select the type. We'll enter one of each of these so that we can discuss them all. First, we'll plan to purchase a fixed asset. A fixed asset is a large purchase like a piece of processing equipment or a vehicle. First, we enter a description of what we're buying. We'll plan to buy a new pickup truck. Next, tell when we are thinking of buying the truck. Here we enter how much the truck will cost. This kind of purchase cannot be expensed and must be added to the balance sheet as an asset. Here we select the fixed asset line item where we want this truck to show up. When we buy the truck, the $35,000 value will show up in the asset account. However, when we buy a fixed asset, its value in our balance sheet will diminish over time. This is called depreciation. The program can depreciate the value of this asset over time if we enter accurate information in the next few fields. First, we enter the useful life of the asset in years. We anticipate getting 12 good years of use out of our new truck. Next, we tell how much the truck will be worth at the end of the 12 years. We'll enter $3,000. Finally, for each projected month after the purchase of our truck, the system will decrease the value in our asset account accordingly. We must pick the financial statement line item where the expenses for decreasing our asset will be reported. Now we'll say OK to finish our entry. Well, now we've shown our plan to buy a truck. Where are we going to get the money? We may have to borrow the money to buy the truck if we don't plan to have $35,000 sitting around in our checking account. Click the Insert button and select New Long-Term Debt. Long-term debt is a loan amount that will be repaid over a long period of time. In the description field, we'll say this is a loan to buy our pickup truck. We'll select the same month and amount we chose before when we set up the fixed asset purchase. This time, however, the financial statement line item will be a long-term loan in our long-term liabilities section. When we take out the loan, the program will add $35,000 to cash and add a liability of $35,000 to this section. We do plan on making monthly payments against this loan, so we'll fill out the remaining fields so the program can decrease our cash and decrease our liability a little each month. Enter the interest rate and the number of months on the vehicle loan here. The program will actually split each payment up into a principal portion and an interest portion. Pick the interest expense line item from your income statement here. Now click OK. Next, we'll record the sale of a fixed asset. All we need here is a description of the proposed sale, the month in which it will be sold, the amount of the sale, and the fixed asset line item. Next, we'll record some new short-term debt. Short-term debt is a borrowed amount that will be paid back in the same year in which it was borrowed. We're going to borrow $10,000 that we plan to pay back within 3 months. We'll make the appropriate entries here and click OK. Now we'll enter an additional item to pay back the $10,000 3 months later. Click Insert again. This time we'll record the addition of new capital. This is investment of cash into the company by an owner or an investor. We'll say that we're going to sink $50,000 into the company during this month. The $50,000 will be added to cash. Choose the correct line item in the equity section of the balance sheet for the offsetting entry, and click OK. Click Insert again. Now we'll plan to take some money from the company. Select Owner Withdrawal and Dividends. This means we're planning to take cash out of the company to pay an owner or pay dividends to an investor. Once again, the money will come out of cash, but we must select the correct equity line for the offsetting entry. Finally, we'll add a line item for payment of projected taxes. This will probably happen in the last period of our fiscal year. Here we will select the proper line item for tax expense. As you can see, there's a world of opportunity for adding, deleting, and tweaking your projections of sales, costs, general expenses, and management discretionary items. Finally, we can print reports to see how our company will fare, given our projections. click on the Analysis tab. There are a couple of setup items we can complete here. First, we need to tell the system whether our balance sheet should start at 0 or use current numbers from our selected fiscal period. Next, we can click this button and indicate which financial statement line items are used for current assets, total assets, current liabilities, equity, and total liabilities and equity. These settings will be used by the program to create liquidity ratios on our pro forma balance sheet. Now comes the fun part. Click on Cash Flow Projections. We'll print the detail version. This report shows our projected beginning and ending cash balance for each month for the next 3 years. Wow! Now we'll print the summary version of the cash flow projection report. This shows the same numbers but summarized for each of the 3 years. Now we'll print both the detail and summary versions of the income statement projection. Notice how the printout provides projected profit figures for each month and on the summary report for each of our 3 years. Finally, we'll select the pro forma balance sheets. This shows what our balance sheet looks like currently and what it will look like at the end of the next 3 fiscal years. The great thing about this program is that you can make small or big changes to any of the entries we've discussed and immediately reprint your results. As you can plainly see, this program can be an extremely valuable tool for helping you make crucial management decisions regarding the operations of your company. This concludes this training session on General Ledger projections.